Good morning, everybody. My name's Kim Reynolds, and I'm here today with Natasha Wilson, part of Vincent's tax advisory team. And we're here to provide you with a tax update for what's been happening in the tax world in recent times, and just to go through some of the updates and some of the things to keep an eye out for over the coming months and next 12 months or so. So before we start today, just like to provide a reminder to people that the information that we go through today is really of a general nature. We can't cater to everybody's circumstances in such a short presentation, but if you've got any questions that come out of the issues that we touch on today, then feel free to reach out to us and we can provide you with some specific advice in relation to the matters as they impact on you personally. As I said, my name's Kim Reynolds and I've got Natasha with me as well. We're both part of Vincent's tax advisory team. And I guess just before we go into the session today, I'd just like to provide an acknowledgement to country. So beginning the day by acknowledging the traditional custodians of the land on which we meet today, which for us is the land of the Yugara and Turrbal people, and pay my respects to their elders past and present, and also extend our respect to the Aboriginal and Torres Strait Islanders, peoples that might be here today. So the first, I guess, section of the presentation today is in relation to legislation that we've seen in recent times. Now, as we're all fully aware, we had an election earlier in the year, and as a result of that, the progress of legislation through the Parliament was stalled, and is gradually getting up and running again as the year has progressed, subject to the current hiatus at the moment. But there are a few pieces of tax legislation starting to roll through, and we'll just touch on some of those items now that none of them have passed the Parliament as yet, but we're expecting that they will by the end of the year. So the first piece of legislation I just wanted to touch on was a tax measure that relates to corporate tax transparency. I think we've all seen over recent years an increased focus on large corporates, particularly being asked to be more transparent about their tax positions across the world, but we've definitely seen it here in Australia. And there has been legislation in the past requiring particularly foreign companies to be transparent about their tax positions, and that was based on a particular income threshold, which was about $200 million of total income. Now, that legislation that's been introduced has lowered that corporate tax transparency reporting threshold. It's a bit of a mouthful. For us, also to include Australian private companies, and the threshold is down to $100 million total income. And that's effective from the 1st of July 2022. So we're going to start to see more Australian companies being reported by the ATO. When I say reported, there is certain information that the ATO will report about these organisations so that they will become more transparent, I guess whether they like it or not, in relation to their tax positions Australia-wide. So after the end of the 30 June 2023 year, I expect that there'll be a little bit more coverage in the media about these reporting information that the ATO will release at that point in time, because it will definitely capture a lot more entities generally because of the lowering of the threshold, but the inclusion of Australian private companies will also have an impact and create a lot more interest, I expect. At the other end of the spectrum, as far as individuals are concerned, the government has announced that there will be a change in the income test threshold for the Commonwealth Seniors Health Card recipients. So if you're currently a senior single, and you've got access to the Seniors Health Card, your income threshold has to be below 57,761,000. So that threshold is now going to increase up to 90,000, and for couples, the threshold's currently about $92,500, and that's going to increase to $144,000. So that means that there'll be a lot more people that will be likely to be eligible for the Commonwealth Seniors Health Card, and something for people to keep an eye on. There's obviously an application that needs to be lodged with Centrelink to get access to the card. It's not an automatic thing. The application process is it's quite a lengthy application, and I've noticed some people that I've worked with when they've been applying for it have wanted to give up partway through, but it was definitely worthwhile getting to the end of it to get and find that they do actually meet the criteria and get access to it. So the income threshold is only one part of it, but it's something that if you've got clients in this space, or you personally or your family have members that might be eligible, it's worth keeping in mind and looking at possibly preparing for making one of those applications. Now, the second more significant tax bill that's been introduced has a few things in it, and one of those relates to the way that the ATO can impose penalties on taxpayers where they might not do something correctly, or there's a penalty to be imposed because of they haven't paid the correct amount of tax or the like. So rather than incurring an administrative penalty imposed by the ATO can require taxpayers to instead complete a record keeping course. This was announced earlier in the year, so it's something that the new government is going to continue pursuing. And I think there's a bit of a theme, as we'll see as we go through today, that more of a theme of record keeping and governance generally in relation to tax matters being a real focus across the board. And this is, I guess, one way that the ATO can and the government can ensure that taxpayers generally increase their awareness of what the records are that they need to keep, and more front of mind as to how to substantiate some of the claims that people are making. So we'll see more and more of this over the next little while in the coming years, I expect, and we're seeing more of a push down or trickle down of the requirements of I guess big business have had to have quite stringent record keeping over the years, but we're seeing that push down to the small business sector and individuals to be able to substantiate claims. It's always been there in the law that you need to be able to substantiate your claims, but there's obviously various levels as to how that's done, and the ATO wants to make sure that there's some sort of awareness or increased awareness in the public domain of that necessity. The second item there on the slide relates to an ATO reporting regime for electronic platform operators. Now, we're all seeing that there are more and more interactions that we have with business these days where it's taking place on an electronic platform rather than necessarily face-to-face, and as a result of that, there's the ATO is trying to, I guess, suck up as much information as they can to ensure that the right information is being disclosed to the ATO, both from the consumer perspective but also from the business perspective. So from the 1st of July 2023, the ATO is going to have a reporting regime in relation to taxi travel and also short-term accommodation. So Airbnb and Uber, for example. At the moment, a lot of these platform operators voluntarily provide information to the ATO to enable them to data match with taxpayers, but this will be legislated that the ATO will actually be able to require that information to be provided to them. And then from the 1st of July 2024, the intention is for all other transactions using these platform operators that they also be part of this ATO reporting regime. So I think we'll see a lot more information. I'm continually surprised, I guess, at the amount of data matching that does go on, but it's getting more and more, and so we'll see a lot more information coming through from the ATO, where they'll be telling us as accountants, for example, whether a taxpayer has interacted with a particular platform or not, and what we should be expecting to see for tax return purposes, for example. The self-education expenses claims that I'm sure that we've claimed, or we've got clients that have claimed over the years. There's always been, for as long as I can remember, a $250 non-deductible threshold. So you would work out what your self-education expenses were, take off $250, and then claim the rest of it. It's always been just a crazy threshold amount that, like I said, it's never really changed. That is proposed to be removed effective from the 1st of July 2022. But that's really all that's changing in relation to that. It's the threshold amount that's disappearing. It's not going to get rid of the need for us to ensure that the self-education expenses that are being claimed are actually eligible for claiming, and that they fit into the relevant criteria. And we'll go through a little bit later a case where it sort of reinforced, I guess, the importance of understanding exactly what those self-education expenses are for and whether a claim is available or not. Another aspect of this particular bill relates to downsizer contributions in the superannuation space, where previously the eligibility age for downsizer contributions was 60, and now that's being reduced to 55. So something to keep an eye on for those of us that are in that age range, or have clients that are looking to sell their homes, and whether they can contribute to super using those downsizer contribution rules. And something, I guess, a little bit different, but from the previous bill, that this is very specifically in relation to the electric car market. So there's been a focus on, well, there is a focus on ensuring that we increase our take-up of electric vehicles for a whole host of reasons that I won't go through now. But and one of the downsides of, I guess, getting into that market is that people see that there's a price point that they can't go above, and they're expensive here in Australia. So the government's looking at ways that we can encourage more people to buy electric cars, increase the take-up, which also means improved infrastructure, etc. as well. But one of the ways that we're looking at increasing people's take-up is to provide businesses with an FBT exemption, where if employee has if the business has an electric car that's available for an employee's private use, then provided certain criteria are satisfied, then there will be an FBT exemption available in relation to the private use of that car. So the exemption doesn't apply for cars that are above the luxury car tax threshold, and it will also only be eligible for cars that are first held and used from the 1st of July 2022. So there's a few issues around, questions, I guess, about how we deal with cars that were purchased before then and are bought second-hand after the 1st of July, imported vehicles, etc. There's a few questions around about that. There's also questions about if we aren't fully entitled to the exemption because it's over the luxury car tax threshold, how do we just practically deal with employee contributions for electric cars, etc. So there's a few issues, I guess, this legislation has got us thinking about that are outside the exemption. But I guess it's all looking in trying to push people in the direction of increasing the take-up of electric vehicles. The third measure that's been introduced just recently, I think it was just last week, that the government introduced amendments to reduce the tax rate on certain income that's earned by foreign resident workers that participate in the Pacific Australia Labour Mobility Scheme. So trying to get people from the Pacific Islands to come to Australia to provide labour. Then the tax rate, marginal tax rates start generally at 32.5%, and this amendment is proposed to reduce the tax rate to a flat 15%. This is in acknowledgement of the shortage of labour that we're finding, I think probably across the board in Australia at the moment, and trying to make it a bit more palatable or favourable for people to come here and do some of the work that we need doing. So yeah, so that was released last week. Now, interestingly, we've all seen in the last couple of years that there've been quite a number of grant programs that have been introduced in relation to COVID and the trying to promote the economic recovery in relation to how we're coming out of that period of our lives. There seemed to be a number of business grants that weren't initially included in the government's tax treatment of these grants. So generally they may not be taxable. So this particular declaration will provide additional grants to have access to being non-assessable for the recipients. Mainly Victorian and ACT business grant programs were included in this, and I've included a link here to the on the ATO website where they've got a good summary of the tax treatment of various Australian government payments that were particularly related to the COVID stimulus and the like. So yeah, it's always worth keeping an eye on that list and checking and double checking that any grants that are received, what their tax treatment is, because you might think that they shouldn't be taxable, but there might be some quirk in the legislation, or they might have just been forgotten off the original list, like we found in a couple of these, that mean that they're not necessarily going to be non-assessable. Now, we've also got a couple of pieces of draft legislation, so haven't been introduced to Parliament as yet. They've been released by Treasury as exposure drafts. The first one of these relates to a skills and training boost. Now, the previous government announced this in the federal budget in March, and what this is intended to do is to apply to small and medium businesses that have got an aggregated annual turnover of less than $50 million. And what it will do is provide an additional 20% deduction for eligible expenditure that's incurred in relation to training of employees. So it's providing external training for employees. So you essentially get a 120% deduction in all in relation to expenditure that meets the criteria. Now, as I said, the expenditure has to be incurred in relation to external training that's delivered to employees by providers that are registered in Australia. So there is a list of approved providers, and the training that they deliver needs to be within the criteria that they've been granted their registration for as well. So again, a little bit more when we're looking at claiming deductions for training expenses, particularly in 2022. looking at 2022 and beyond, is looking at where that expenditure was incurred. What was the training on? Was it, if you've got a line item in the P&L that says staff training, then what's in there? Is it internal training that's there? Are they external? If they are external, then do they meet the criteria for being eligible for this training boost? And if so, we need to be able to identify those, because then we can look at claiming that boost at the time that the claims can be made. So just on the timing side of things, the eligible expenditure is expenditure that's has been incurred since budget night on the 29th of March this year, up until the 30th of June 2024. The government expects that it will introduce the legislation into Parliament this year. So essentially what that means is, while we're doing, as I mentioned before, for the accountants on the webinar today, that while we're doing our 2022 financial statements and tax returns for clients, we need to be, and even as businesses, while you're putting that information together, we need to be able to identify the types of training that would fall into this eligibility criteria between the 29th of March and the 30th of June. You can claim your 100% deduction where it's deductible to in the 2022 year, but the 20% boost deduction would be claimed in the 2023 year, because the tax return systems at the moment, and the format doesn't include an ability to collect this information about the boost. So you claim the 100% in the 2022 year, but claim the additional 20% in the 2023 year. And in 2023, you'll claim the full 120% of the expenditure. But I fully expect that we are going to need to be able to substantiate this, going back to my point earlier about record keeping, making sure that we actually can show that we've incurred the expenditure in a manner that meets the criteria.
And it's probably a good time to start doing that and getting those records together now, I suppose, as well, even though we won't be able to claim the deduction until next year, rather than having to go back for a full year of training expenses and try and find everything.
That's right. It'll be much easier as we do it this year. Yeah. Now, along the same vein, again announced in the budget in March, is a technology investment boost. Now it goes along similar lines. It's available to SMEs that have got an aggregated annual turnover of less than $50 million, and provides a 20% boost deduction, in addition to the deduction that's available for the eligible expenditure that's incurred on assets and expenses relating to digital operations of a business, or for businesses that are digitizing their operations. So overall, again, you get 120% deduction. Different to the skills boost, there is a maximum bonus deduction here of $20,000 per income year. So essentially, you spend $100,000, you get an extra $20,000 deduction. Similar to the training boost, the eligible expenditure needs to be incurred between the 29th of March, but finishes on the 30th of June 2023, so it's a year shorter. And it has to be eligible for a deduction under some other provision in the tax law, so which I think that makes sense. If the expenditure is on a depreciating asset, then the asset needs to be first used or held ready or installed ready for use by the 30th of June 2023. And also in relation to claiming the deduction for the boost in relation to a depreciating asset, if you purchase a depreciating asset, then you will only claim a percentage of the expenditure over a period of time, over the life of the asset, because that's the way the depreciation rules work. However, as far as the boost is concerned, if you've spent, let's say, $100,000 on a depreciating asset, you will depreciate that over time, so you won't claim a full $100,000 on the expenditure in year one, but you would be able to claim the $20,000 or 20% boost deduction in the year that you acquire it, provided the asset is first used and installed ready for use in that year. There are certain kinds of expenditure that won't be eligible for the boost, and that includes things like salaries and wages. So making sure that where we're looking at how assets are classified and what's put into the cost of the asset, we need to ensure that we're correctly identifying the eligible expenditure. And again, similar to the skills boost expenditure that was incurred in the 2022 year, the boost gets claimed in the 2023 year because of the way that the tax return system is set up at the moment. And finally, just recently released in draft legislation about simplifying FBT record keeping requirements. I think this has been the bane of people's existence as far as FBT is concerned for as long time. So the idea is to simplify the information that is required to be kept in relation to FBT and the benefits that we provide employees. The draft legislation says that it's relevant for employers that maintain good corporate records. So again, going back to that point I made earlier about good record keeping, good corporate governance, this is another example of where that's going to come into play. So essentially, it will allow employers to rely on their existing corporate records rather than employee declarations or other prescribed records that are in the FBT legislation, provided those alternate records are adequate. And the draft legislation outlines what it views to be adequate alternative records that will be accepted, and looks at those alternative records that can be kept, particularly in relation to things like travel diaries and expense payment benefits for relocation expenses and the like. So something to keep an eye on. And like I said, it's draft legislation, just been released by Treasury, not yet in Parliament, but something that will make those of us that work in the FBT space and also employers that provide benefits to clients, make it a lot easier for them to deal with. So in relation to rulings, there's just a few that we just wanted to touch on. One is in relation to Division 7A, which impacts on a lot of clients that deal with private companies and private groups. So just a bit of history in relation to a tax determination that was released. Back in 2017, there was a practical compliance guideline released by the ATO that enabled us to convert sub-trust arrangements that provided them essentially an additional 7 years rather than having to pay the principal of the loan on maturity. And historically, since the issue of that PCG, the treatment has been extended annually. And it applied where the trustee that had an unpaid present entitlement to a private company placed those funds on a sub-trust arrangement for either 7 or 10 years, and it was an interest-only loan for that period of time. And there were two options that were available under the PCG, and essentially avoided the application of a Division 7A deemed dead end at the time. And as I said, that treatment was extended annually, and for the year ended 30 June 2022, it was extended again. However, this ruling, or this determination, now provides that a private company beneficiary, so if a trust distributes to a company and doesn't actually physically pay the distribution, it's an unpaid entitlement, then that company beneficiary will be providing financial accommodation to the trustee if certain conditions are satisfied. So if it's an unpaid entitlement, then when the company has knowledge of the amount that it can demand immediate payment of, but it doesn't demand the payment. Or if amounts are held on sub-trust for the benefit of the company knows that the shareholder or the associate is using the funds. So, and this can occur even if the sub-trust fund is being held on commercial terms. So that's irrelevant for the purposes of these Division 7A rules applying. It applies to trust entitlements from the 1st of July 2022, so it doesn't apply to your 30 June 22 distributions, but it will apply from here on. And importantly, from a private company or private group perspective, a private company is going to be deemed to have the knowledge at the same time as the trustee of the trust if it's got essentially the same directing mind or will. So if you've got the same family group and the same people are in control of the company and of the trust, then it'll be seen to be the same directing mind and will, and therefore these timing rules will come into play. So essentially means that the old subtrust arrangements that we might have had have almost gone out the window. They'll be very plain vanilla from here on, I expect, and there'll be a lot more consideration of actually physically paying the distributions from trusts to companies. A couple of tax determinations also in relation to capital gains tax and non-resident beneficiaries. So in situations where capital gains were attributable to assets that aren't taxable Australian property, they may not result in a tax liability where the beneficiary is a foreign resident or a temporary resident of Australia. A temporary resident beneficiary of a fixed trust. So it doesn't apply in relation to a non-resident beneficiary of a non-fixed trust. So these streaming rules are really just, and the legislation the case law that's brought this about was Peter Greensill, the family company where we had capital gains that were offshore, but they came through an Australian trust, an Australian discretionary trust, and then distributed to somebody offshore, so a foreign beneficiary. And the argument was that they were not Australian taxable assets or gains, and therefore shouldn't be taxed as they flow through the trust. And the court found that wasn't the case, that once they'd gone through the Australian trust, they became essentially had a source in Australia, and so there was a liability here. And this really, I guess, has changed people's understanding of, or given us more food for thought, I guess, in relation to how the CGT streaming rules that were introduced about 12 years ago really apply to trusts and how we structure the investment in assets that might be sitting offshore as well as onshore. Because it's a determination from the ATO, it does, they have said that it applies retrospectively, but for pre-2019, 2020 income years, the ATO said that it won't devote compliance resources to identify those arrangements that would give rise to adjustments. I guess in my experience is that although the ATO won't devote those compliance resources, if they come across this particular issue while they're looking at something else, then there's probably no reason why they won't at least ask the question as to how it should apply. And this is an accompanying tax determination that really just finalises the ATO's long-standing view. Again, it's come out of the decision in the Greensill case, where non-resident beneficiaries or resident non-fixed trusts, so a discretionary trust, isn't able to disregard the capital gain, whereas a fixed trust could disregard that under Division 855. Okay, so I might just hand over to Natasha now, and she can go through some of the cases that we've seen.
Okay, so the first case that we've got here involved an Army officer who was denied deductions for some self-education expenses. So Kim touched on that we were going to mention this case earlier. So what he tried to do was to claim units for a law degree. and he was a general services officer in the Army. So he began his postgraduate law degree in 2018, and he subsequently received a promotion in 2022. He claimed that the studies improved his skills that were necessary for the role, and also claimed that they led to his promotion. However, he was denied those deductions because it was held that they were too general in nature, so they weren't specific enough to his role. And although tertiary study was viewed favourably by the promotions committee, it wasn't required, and it couldn't be regarded as having led to an increase in his income. So the key takeaways here, I think, are that it's a good reminder of the nexus that's required between the study and the employee's current job. And it is important that we're asking clients further questions who are giving us the information to claim the self-education expenses to establish whether it is really directly related to the current role or to some kind of promotion that they're going to get in that current role. So it is a lot narrower than what a lot of clients tend to think, and we might usually accept things as they're given to us, but digging a bit deeper is probably important coming off this case. And also because that $250 threshold or reduction has been removed, as Kim mentioned earlier, the ATO might sort of be looking at this a bit more closely.
Yeah, I think you're right.
Yeah. So the next case we've got here, although it does have Mr. Gould's name to it, who you've probably all heard of, and who obviously has no credibility as an accountant or a taxpayer really, there are actually some key takeaways from this case that can be applied to areas of tax that we do all deal with quite frequently. So this case involved deductions being denied for management fees, interest and bad debts. So first, looking at the management fees that were denied, this was a fixed amount that was claimed that resulted in nil taxable income. So I think for one of the years it was that very specific amount of $123,276. And it was also decided after year end that was what the management fee was going to be. There were also inconsistencies in the way it was recorded in the inter-entities. So the other side of the transaction, being the income side, wasn't recorded in the entity which purported to have charged the fee, in the entity that claimed the deduction. So it was found that claim, that management fee, was just a sham, and was clearly just they plucked a number out of the air that was going to give them a good tax result at the end of the year. The next one there is the bad debts that were claimed. So they were arising from some loans to various entities that had been written off, and it was claimed by the taxpayer that there was enough evidence to constitute a business of money lending of the taxpayer. However, the evidence again was contradictory, and there was nothing reliable supporting that the trust had ever derived any income from the loans, or that those debts were actually bad. Then the third one there is some interest claims. So that was broken down into onshore and offshore debt. So with the onshore debt, it wasn't established that the loan ever actually carried interest, and the amounts claimed were disproportionate to the capital sums borrowed. So that obviously didn't look very good. And then the offshore debt, they just couldn't prove that the amounts borrowed were actually used for income producing purposes. So with those ones, they did an analysis of the bank account of all the funds that were borrowed and separated them out into 21 categories for the purposes of assessing deductibility. And I think it was only about 5 categories that they could actually prove that the money had been used for an income producing purpose. So again, this is going back to that record keeping piece, and also that journal entries are not transactions. It's important to remember that. So we need to have adequate records evidencing that transactions have actually occurred. For example, loan agreements and other formal documentation and file notes, and also a commercial justification that has actually happened, and we just haven't processed a journal at year end and come up with some number. And also, if we've got things like loan agreements, if that loan agreement's charging interest at a certain rate and at certain periods throughout the year, we should be making sure that we are actually paying the interest or charging it and recording it as such, so that we can prove that those documents do have some kind of commerciality behind them.
And I think one of the other points that was raised in the case was that things like management fees, there would be an expectation that there would be a discussion at the outset as to what the management fee would be for a year. So having that conversation at the start of the year rather than having it at the end of the year, and particularly after year end, to get it to just work out to the dollar to get rid of all of the taxable income. So having those discussions earlier on in the year and setting out what that, if there's a management fee or if there's interest to be charged on loans, what those loans really look like, whether loan agreements should be in place, and ensuring that if loan agreements are in place, that people are actually paying abiding by the terms of the loan. So whether there are interest payments due or principal repayments due, then making sure that those happen in accordance with the loan, because it's one thing to, like you said, to have that documentation, but then you've actually got to follow it as well.
Yeah. I think if you're providing something to the ATO as evidence, and then they look at it and go, well, you haven't actually followed what this says, so how is this supporting that transaction?
Exactly right.
It's not going to look so good. So I think that last key takeaway there sums it up. I think that an act of will, no matter how genuine you are, doesn't overcome a lack of documentation, contradictory evidence, unreliable journal entries, or transactions with no plausible explanation.
Okay. Which leads you to the next case that probably demonstrates that as well.
Yeah, so there's definitely a big theme of record keeping and being able to support your claims and your transactions today. So this case involved a taxpayer who was assessed on basically all the deposits in their bank accounts because they weren't actually able to prove what their taxable income was in that year, and they also couldn't provide any evidence that was capable of explaining their income earning activities. And so unfortunately for that taxpayer, all those deposits were treated as assessable income, and that was despite him contending that the amounts were loans from parents and a third party, not income. So obviously that goes back to record keeping again. Probably didn't have any documentation to prove that they were loans, and again couldn't actually prove what that taxable income was. So it just highlights the importance of keeping contemporaneous records to explain your withdrawals and expenses, but also your deposits and income. So I think we're always very focused on making sure that we've got invoices to explain the amounts that we're claiming as tax deductions, but it is equally important to be able to explain your income so that the ATO can't come in and just deem that every single deposit in your bank account was taxable income.
Yeah, well, sometimes if the ATO is looking at a taxpayer that is in a situation that the Goldsworthy was in, they'll do something called an asset betterments test. So they will look at the assets that you've got, compare that to what's in your bank account or what's gone in and out of your bank account over time, and try and come up with a taxable income over the period based on the ins and outs. I guess our recent experience has been that the ATO doesn't necessarily always go to that approach. An easy out, I guess, from their perspective is that they do just look at the deposits in particular bank accounts and say, okay, well, we're just going to add up all of these deposits. We'll ignore all of the withdrawals, but we'll add up all the deposits and we'll say that's all income. And given the onus of proof is with the taxpayer, it is really important that there is that ability to explain where those deposits have come from. Even when they're transfers between bank accounts in need to be able to adequately show that they are going from account A to account B.
Yeah, it's unfortunately not up to the ATO to prove that the amount is income. It's up to the taxpayer to prove that it's not.
That it's not.
Yeah.
Exactly.
Yeah.
Yes.
All right, so the next case for something a little bit different to what we've been talking about, a little bit less of a tax focus, I suppose. This case involved the removal of a trustee who was deemed to not have given real and genuine consideration to all circumstances in relation to the beneficiaries when exercising the power to appoint income to the beneficiaries. So this trust was a mum and dad trust. So we had John and Eva, who established a discretionary family trust, and they'd named the primary beneficiaries on the trust deed as the children of John and Eva, and there was also a default distribution clause which named the children of John and Eva. So John and Eva had 3 children, and as a result of a family breakdown, they favoured one of the 3 children when they were determining the distributions at year end. So as a result of that, the other 2 children sought orders to remove the trustee due to a breach of fiduciary duty to give real and genuine consideration to all of the beneficiaries, and those distributions were deemed voidable, and that the trustee was also removed. So often we consider, when we're looking at distributions, we consider things from a tax and accounting perspective and what that impact is going to be, but we probably don't think about this that often. And clearly from this case, it is important, and especially where there might be situations where there are family disputes and things like that, or family members don't get along, it is something that we need to be careful of from a legal perspective.
And I think there's more and more dispute in this space, that where beneficiaries are saying that they haven't been considered properly. We find it in the estate space quite regularly, but also, as this case demonstrates, in just a regular discretionary trust, and also the situation where beneficiaries are saying, well, the trustee says they've distributed this to me, but I disclaim that interest, I don't want it. So there are a lot of trust law issues that come into dealing with trust, as you would expect, and obviously the distributions that flow from those trusts. So it's important, I guess, when we're looking at, from an accounting perspective, we're looking at accounting and tax perspective, we're looking at distributions from trusts and how we manage the trust, to not lose sight of the fact that there are a number of legal issues that also need to be contemplated. And as Tash said, where you've got a potential for family dispute, then there are those additional things that you may need to cover off on with the trustees to ensure that they've actually given consideration to some of these issues, as to, in this example, why has one child been favoured over the other 2, and to ensure that they can actually document their reasons to show that they have given real and genuine consideration to why that distribution flowed the way that it did.
Yeah, and I think it's probably more important when you do have primary beneficiaries named like that on your trust deed, and it's just another reminder to always read the deed and be aware of the beneficiaries that are listed there. And the other point I was just going to make with that is that failure to give real and genuine consideration means that a court may declare distributions as void, but for them to do that, the aggrieved beneficiary needs to apply to the court for a declaration that a particular transaction was void. So the other 2 children hadn't sought an order to declare the distributions as void, and so the court actually refused to allow them to amend their pleadings to cover that ground. But the point there is that if they had been able to do that, then the distributions could have been void. So this next one was a GST case. It was a partnership who which had lodged their BASs more than 4 years late. So they were actually denied all of the input tax credits up front in relation to those BASs. So there were amended GST assessments denying input tax credits totaling just over $16,000, and the Commissioner's system actually automatically reversed those input tax credits on the same day that the BASs were lodged, so it was an automatic thing. And the taxpayer tried to argue that they weren't aware of the 4-year time limit and that the ATO had given them verbal extensions over the phone, but that simply wasn't expected. So, and the reason for that is that there's actually no discretion to the operation of Division 93, which is the division stipulating time limits on input tax credit entitlements. And so the other key takeaway there, I suppose, was just to be wary. If you are taking on clients that haven't lodged BASs for several years and there is a lot of work to do, that you may need to get some of those BASs done ASAP in order for them to actually get the input tax credits. The next case is a case about employees and contractors. So looking at the definition of an employee, mainly for SG purposes. So this one involved a uni lecturer who was paid an hourly rate for lecturing students and marking exams. And then JMC, which was the university, had oversight and control over when, how and where the teaching services were provided. And although the uni lecturer was allowed to delegate some of the teaching responsibilities, provided that the subcontracting party was appropriately qualified, JMC actually had an unconditional right to decline that at any point. So it was a limited delegation right, I suppose. So JMC was subsequently issued with assessments for super guarantee, and they tried to argue that the contractor, as they thought he was paid a fixed sum to produce particular results. So the results being delivering the lectures and marking the exams. However, his written contract stipulated that he was paid an hourly rate, and that was ultimately one of the key points that led him to be deemed as an employee for SG purposes rather than a contractor. So some key takeaways and sort of reminders from this case is that the mere right to delegate isn't decisive, and that the terms in the written contract are actually important. So even though they tried to argue that he was producing results, the contract said he was paid an hourly rate, and that was that pretty much. So I've also just got a reminder there of the extended definition of an employee for SG purposes, and that there must be a contract. The contract must be for the person's labour, and the person must work under that contract. And also that the penalties and charges for non-compliance with the super guarantee can be significant. And I think the other point there, which we were sort of talking about yesterday, was that this could have an impact on the PSI rules in looking at that results test.
It's looking at, I guess it's remembering what it is that you're considering when you're looking at whether somebody's being asked to produce a result or being paid an hourly rate or the like, because it can apply for SG purposes, payroll tax, PSI. It's a number of areas that it can go across. Just because we get a particular result in a SG case doesn't necessarily translate across to a situation where we're dealing with PSI or payroll tax, but that doesn't mean you ignore it. You do need to take into consideration what are the factors that were considered in each of these different areas, because there could be some flow-on effect in interpretation across each of them.
Mm. All right.
Okay, so just another couple of non-legislative ATO type issues to cover off on, just as we're seeing, as I'm sure a number of people are, a lot more crypto asset transactions that are happening. So a lot of digital assets that people are buying or trading in that we need to get our heads around. And yeah, for some of us, it's a brave new world. So from something to, I guess, to keep in mind with the way that the ATO is currently dealing with digital assets and transactions. Back in 2021, but it was only last year, the government of El Salvador allowed Bitcoin to be legal tender in that country. And as a result, that created some uncertainty probably around the world, but I know it's caused some discussion here as to how it impacts the application of our foreign currency gains and losses rules. So, our Forex rules here in Australia, you can include foreign currency gains and losses as assessable income or allowable deductions when they're realised. So El Salvador saying that Bitcoin was legal tender, then from a layperson's perspective, you say that it's now foreign currency, so do our foreign currency rules apply to that? Legislation, the government has said that legislation is going to be introduced to clarify that cryptocurrencies will continue to be excluded from the foreign currency tax arrangements from the 1st of July 2021. So it essentially means that capital gains tax will continue to apply for crypto assets that are held as investments. But just there's a lot of information around out there from clients and businesses dealing with in the crypto world just generally on a day-to-day basis. So a lot of conflicting information. So I think it's important to keep our eye on what the ATO is saying is how they're going to be administering these things until we get some clarity as far as the law is concerned. But yeah, there's a lot happening in this space. Another demonstration of that is that the Board of Taxation has released a consultation guide in really providing a good overview of crypto assets and the current tax treatment in Australia, and have outlined a number of issues that are going to be considered as part of the consultation process. So things like, how do we currently treat crypto assets? What's the level of awareness of the tax treatment of those assets, which in my experience is many and varied as far as the awareness is concerned. What are the characteristics and features that we see in crypto assets so that people can we're all on the same page to understand what exactly are the things that we should be looking for that set a crypto asset apart from something else. How are they being treated internationally? As I said before, with some countries looking at making it legal tender, there are governments that are looking at whether there can be a national crypto type currency. That's all going to come into play, as far as these consultations are concerned as well. And whether there are any changes that are required to our laws, tax laws particularly in relation to dealing with crypto assets and administering those, getting data, accurate data in relation to trading in crypto assets, and on a timely basis is important. But yeah, so there'll be a lot more to see in this space over the next little while.
So just a couple more quick things in the last 1 minute. We've got another update here, and just a reminder for Division 7A loan repayments that the ATO previously provided an extension of the repayment period for minimum yearly repayments under complying Div 7A loan agreements where repayments were unable to be met because of COVID-19 impacts. So a specific application had to be completed for this, and if that is something that impacted your clients, any shortfall amounts approved under this extension should have been paid by the 30th of June. So where that amount has not been paid, an amendment to the 2021 tax return will actually be required to include a deemed dividend representing the shortfall. And also just some ATO focus areas for this tax time. We've got rental properties. So ATO are focusing on taxpayers with rental properties because there have been a lot of errors in tax returns around that. So we need to be making sure that all rental income is declared. So that includes insurance payouts and retained bond monies, which might be applicable due to things that have happened over COVID and natural disasters and floods and things that we've had where people have had insurance payouts. And we also need to ensure expenses are claimed correctly and apportioned for any private use. And it really comes back to that record keeping piece. We need to make sure we've got adequate records, and we need to make sure that we're interrogating clients a bit further to make sure that we are only claiming what they're entitled to and that we do have details of all of the income that's been earned.
And making sure also that, you know, things like repairs and maintenance, that we're actually classifying things properly along the way. So it comes back to that record keeping and getting the right amount of data.
Yeah. And the other areas that the ATO is focusing on are record keeping, again, which has been a theme throughout today, work-related expenses, and also capital gains. And the key one there, I think, is cryptocurrency, because they're just generally people seem unaware of when they've had a CGT event happened in relation to their crypto. So, and that's another big one where it's been very difficult to get adequate records of clients, and it's been quite time consuming. So it is a focus area that we need to be aware of.
Yeah. Okay, we've hit right up on 12 o'clock. So thank you everybody for coming along today. As I said at the start, if you've got any questions in relation to the things that we spoke about today, feel free to reach out and let us know if you've got any questions. And if there are any other particular tax topics that you'd like a webinar on in future, then please drop us a line and we can see if we can tee up a special topic for you. Thank you again and have a good day.
Thanks, guys.